It's Brian Preston, the Money Guy.
But I want to give you credit. We did a Q&A show not too long ago, and one of the people had asked a question about Bitcoin, it was Bitcoin, because I was thinking, was it AMC, was it Tesla? It was Bitcoin. And he said, hey, look, I want you to make sure you've done all the other steps before you take the going in over concentration into Bitcoin. And I think that is the biggest thing that I see a lot of people doing, is that they've gone ahead and skipped index funds.
That's right.
Index funds, that's for your grandparents. That's what they're thinking. And they go right into whatever the latest, greatest trend is, whether it's Bitcoin, one of the Reddit board stocks like AMC or GameStop, or even, you know, I love me some Tesla, but that's even on this over concentration. So we wanted to kind of do an exercise.
And what we're saying is, we're not saying that in and of themselves any of these things are necessarily bad. Brian, you already alluded to getting it out of order is bad. Doing these things before you've built some base level solid foundation is bad. And as well as putting too many of your eggs in that basket can be bad, and we're going to show you why. We're going to walk you through why that can be bad.
We got better than a why. We got an illustration, because we love to do this the Money Guy way, where we go beyond common sense and actually show you some things. So first thing, we have a chart for you. And I want anybody looking out there, if you're out there in YouTube world, you can see it. But unfortunately, our podcast people, we're just going to have to describe this. I'll give you the Howard Cosell on it. And the fact is that we've got, we don't know if it's Tesla, Bitcoin, AMC.
But it's like a growth chart.
I mean, this thing, you're very happy. If you bought on the left side of this chart, you are so proud of yourself, because, I mean, this thing's looking like it's probably at least a 10-bagger on how much money you made. So you've made at least 1,000% on your investment.
And so the question is, okay, which one of these companies is it? Is it Tesla? Is it Bitcoin? Or is it AMC? You may be surprised to find out that the actual answer is none of these three.
Yeah.
It's actually a different company. And I'd argue for a lot of our audience, thinking about the demo in which we work, a lot of you may have not even heard of what this company is or what the stock is.
Yeah, and this is, like I said, wisdom comes from experience. So as a young financial advisor, I worked with a lot of executives for this company. This chart that we're showing, we'll go ahead and show you the rest of the picture, is Lucent Technologies, that were headquartered in Atlanta, Georgia. I was working for a fee-only firm that we worked with some of those executives. And this is the thing that I think people ought to be nervous about. You think, and look, we love some of these companies. Like y'all know I love me some Tesla, and you see how well Tesla's doing. Lucent Technologies was the 7th largest company in the United States in the year 1999.
So it was like a household name-esque company.
If you were an investor back in 1999, you knew about Lucent. It was very similar. Like I said, the 7th largest company in the S&P 500 at the time. That's pretty powerful. But here's the rest of the story, as you can see from the chart. It got to a high of $130 a share, and then within just a few years later, it was trading at $1, or actually less than $1.
So I want you to think about that. If you owned a share of this stock at its peak, it was worth $130, and just a few years later, it was worth cents, pennies, less than $1. Imagine if you didn't just hold one share of stock. What if you held 100, 1,000, 5,000, 10,000? What if the majority of your wealth was held inside of this company? Your overall total wealth would have been absolutely decimated if what happened to Lucent happened to your portfolio.
So we wanted to kind of go a step further and look at the charts for, let's look at some of the things that are household right now. Everybody's so excited, and they think that, hey, this is what you should be doing. Why should you diversify? Why should you do index funds when you can just go buy Bitcoin? Now, look, it's had volatility. I don't even think this chart shows that we went from 60 to mid 40s within we went bear market status in less than a week. And then I saw today we're back in recovery mode. This thing is all over the place, and we don't know what the future holds yet.
Look, you can't argue against the fact that the trajectory of Bitcoin and the performance it's had to date has been meteoric. It's been unbelievable, out of this world. And we're not saying that that won't continue because nobody knows. We don't know if Bitcoin will continue to move in that direction. Or maybe even if we look at a different company, a company that's near and dear to our hearts here at the Money Guy Show, you look at Tesla.
Yeah.
If you look at what Tesla has done since January of 2020, all the way through the end of 2021, it's been a fantastic ride. And shareholders and participants in that company have been rewarded for that. What we don't know is what the future looks like. We don't know what the next 1, 3, 5, 10, 15 years for any of these individual holdings or individual companies might look like.
So I'd like to pivot because, like I said, you even said it earlier. We're not against any of these investments.
Not at all.
But we do need to make sure we have the right mindset. What would a financial mutant do? And I think this is so important when you're talking about specifically over concentration. Because how do you get to over concentration? Is where you just like. You're just loading it up into something. So here's some things we put together. First, ask yourself, are you investing? Are you speculating?
Now, here's what I think is really interesting, Brian. I know a lot of folks who have waded into the Tesla waters. I'm going to use that as a specific example because they've heard of what's going on and they heard about the rise and they saw the 1,000% return and fill in the blank. They know nothing about the company. They know nothing about the product. And they know nothing about the fundamentals. I was there with you when you placed your very first purchase of Tesla stock, and it had nothing to do with what the stock price was doing. It had nothing to do with how well the market performance had been. You said, Bo, this car is amazing.
It's going to change the world.
It's going to change the world. I love this product. I love this company. I love what they're doing. I'm going to invest, keyword being, in the future of this company, not speculate on what I think the stock price specifically might do or might not do.
Yeah, and I think that's the key part is that I was investing. I told you at the time got my first Tesla, and then I drove it, and I was like, this is the
insane.
best car.
It's
I mean, so I immediately went out and bought some shares of Tesla. This was back in 2018.
Yep.
And then you're right. I've kind of stayed the course, been through thick and thin, because I am investing. I'm not speculating. This is not a momentum trade. And that also leads to the next point that I think is very important. You want to make sure your individual exposure is less than 5 to 10% of your portfolio. And even though Tesla, for me, I mean, we've got to be getting close to a 20 bagger at this point. I mean, we're almost to 2,000% on that initial investment, but it is still less than 10% of my total portfolio.
So I want you guys to hear that. It's okay, assuming you have a foundation in place, if you want to do some speculating, but you have to be aware of that. But let's say that it works, and let's say that it hits, and let's say that you did get on Bitcoin, and let's say that you did hit Tesla ride, or maybe you were on the Reddit boards and you rode that wave. You need to constantly be making yourself aware, is this more than 5 to 10% of my overall portfolio? And if it is, you are rapidly getting to that place to where you are over-concentrated, and the risk inherent in that holding, just like for those loosened executives, might not warrant your participation in the way that you are participating. And so a lot of folks might say, well, guys, I'm not an investor, I'm not a speculator, but I work for this company, and a lot of my compensation comes by way of options or by way of RSUs or ESPP. If you can't control keeping your exposure below 5 to 10% because of one of those factors, you ought to at least have a strategy of how you're going to get back there. And we've even seen this with folks who said, you know what, guys, I took 5% of my portfolio and I bought Tesla, but then it turned over 2,000%, and now it's way more than 5 to 10%. Okay, that's great. Let's come up with a very tax-efficient, risk-mitigated strategy on how you correct that moving forward. Don't just kind of put your head in the sand and ignore what has taken place in your portfolio.
I let it be clear that earlier we worked with some loosened executives at my former company, and here's the thing. I think that a lot of insiders, when you care about a company or on the inside of a company, you're a perma bull. You just assume things are always going to be good.
Right.
Even though you're an insider, that does not necessarily mean that you have it all figured out on where things are going. So what I like, the key word here is strategy. Just like we dollar cost average into holdings by buying monthly over time, you can do the exact same thing when you're trying to diversify out of a holding. You can dollar cost average on your liquidation of that too. So you can do exactly what you said. take advantage of the taxes, and make sure that you're building in, how do we do this in a strategic way so that I respect what I think is going on with this company, especially if you work there, but how do I make sure I'm building wealth outside of this company as well?
And look, we've even had this happen. Someone says, hey guys, I've got this going on. I bought this thing. It did well. I've got 20%. I'm in a high tax bracket. It's 20% of my portfolio. I cannot sell it. We say, hey, great. You know what we're going to do? We're going to save so aggressively in the portfolio that you are going to dollar cost average up the value of your portfolio so that that 20% holding comes down to 5 to 10. That is an appropriate strategy to mitigate that risk, because over-concentration feels great when it's working, but it can be absolutely devastating when it goes awry and moves in the wrong direction for you.